Have you ever been denied for a loan or a credit product? Have you ever realized that it wasn't really you per se, but it was the broader economic circumstances? Your financial institution being concerned of the economic circumstances and tightening up all together? How do you think that has impacted you and your business and your personal finances? How do you think that impacts the broader financial health of the country when the entire banking system is tightened up in that capacity? That's what this conversation is going to be about. A poll I recently ran on my channel asking, what do my viewers believe the impact of tighter bank lending requirements would be for individuals and small businesses and their ability to access capital? So we're going to talk about how that poll turned out, the percentages, what the options were. We're going to talk about what it means for the tighter lending environment for you as a potential individual just looking to advance your finances personally, or as a small business owner. We're going to be talking about what affects bank lending and, them getting tighter. We're going to talk about who's going to get hurt the most, who could benefit the most, and how to position yourself so you can hopefully be on the better end of that situation if that continues on, because honestly, we're kind of already in it. But if it gets any worse anytime now in the future or in the later future, I want you to have a little bit of information, insight, strategy on how you can be on the proper side of a tighter lending cycle. This is JP from Blueprint for Prosperity Network, the creator and architect of the channel. 13 plus years in financial services, 11 plus years in banking and finance. And I have several licenses and certifications across the industry. And the goal on this channel is to help you master relationship banking and maximize your borrowing capacity, because I've observed these are the two founding pillars to financial success in this system. So that having been said, one of the crux of that matter is going to be the health of the banking sector and their appetite for lending. That is a huge variant in the success of the overall economy. So that is a huge topic. That poll ran on my channel maybe about a week or two ago. And again, I asked, how do you believe stricter lending requirements would impact the ability for individuals and small businesses to get access to capital? The options were significantly negative, minimally impacting, and significantly positive. That were the three options on the poll. Of a handful of votes, I believe maybe that vote one got, double-digit amount of votes. It wasn't crazy, but again, always a little bit of a litmus test to the sentiment out there of the viewers and many of us out there. 57% believe significantly negative, 29% minimal impact, and believe it or not, 14% believe significantly positive. Would love to know a little bit more about the minimal impact and the significantly positive. I'm going to actually throw a little bit of a feather in either one of those decisions or those choices, because could be something there with that. But let's start talking about the obvious elephant in the room, which is going to be significantly negative. Generally speaking, we're talking individuals, working class individuals, and small businesses. Generally speaking, tighter lender standards hit us the hardest as individuals and small business owners. So you could be anywhere from just applying for a credit card or auto loan all the way up to a mortgage or various business lending products. We are hit the hardest. I want you to think about a tighter lending environment as a social event where, maybe like a festival would be the equivalent of a healthy lending environment or a comfortable economic environment that's more of an outdoorsy, open to the public social event, right? Like a festival where a scenario where you can pretty much just pull up, walk up. Maybe you have to pay, maybe you don't. Maybe it's just outdoors at a park or some central area, and everybody's having a good time. Music's playing, food is everywhere. And again, it's either low barrier to entry or no barrier to entry to get in. That is what the bank lending cycle is like when the economy is favorable, when it's comfortable, when money's flowing, rates are low, business is booming, GDP is healthy, all the fancy stuff. It's like a festival. It's like a parade. You know what I mean? I'm here in New Orleans, so it's like Mardi Gras. Like, it's just a party everywhere you go. If you want to talk about tighter lending standards, tough economic circumstances, contractions in GDP, inflationary environments, other factors that make the banking system stiffen up, that is going to be a lot more like an invite-only party, right? Like, that's literally like the high-dollar ball or gala that you maybe didn't even knew exist or heard anything about, or you stumbled across and you weren't invited and you can't afford to get in. That is much more of an analogy for what it is like when there's tighter bank lending standards. Because what ends up happening is they're not going to stop altogether, because that's a huge part of how they make their money and they're successful. they're also a huge mechanism in the overall economy as a whole. So even if it wasn't about the profits for them, they have a duty to keep lending because that is what keeps the entire economy going behind us. So lending is not optional. But when you end up in tough economic times, what you do is you start to lend to the more familiar parties, the people who are already in the loop, the people closest to the higher level of economics activity, the asset classes, the wealthy people, the essentials is where you're going to be lending and funneling most of that available capital into. Those people are going to largely be fine because they're already important parts of the economy. They're familiar, they have assets. The security component is there. And we're going to dive, as usual, we're going to dive into the basic Google search of what tighter bank lending looks like, why it happens, etc., in just a second. But that is an analogy I wanted to lay out for further context in this conversation. One is going to be like a Mardi Gras, open festival, open party on the streets, food available. Just walk up and get food from vendors, party, drink, have the time of your life. The other side of the spectrum is going to be literally like the in the know, if you know, like you literally like somebody you knew got a ticket or got an invite. Or, you do kind of hear about this little gala or ball or business event or mastermind, but the ticket price is insane. And only a certain group of people can afford to get in. That is what that is like. So what is the generic Google Guides description of bank tightening and lending, during recession, et cetera? And we're going to go over some of the factors at play and what causes it and what can come from it in a second. And then we're going to break down, as we always do, into how this impacts you, how you can maneuver around this to put yourself in the best position possible to not only not fall victim, but potentially come up during this time. Because if you are in the right position, you can get access to some phenomenal opportunities because of this circumstance as a byproduct. So we're going to get to that right after this. Banks tighten lending during recessions to mitigate risk and minimize potential losses. This includes increasing lending criteria, reducing loan volumes, being more selective about borrowers. Banks also respond to decreasing loan demands during recessions and higher interest rates, which makes borrowing more expensive. Here's a more detailed explanation. So increased risk. Recessions often lead to a rise in defaults, delinquencies on loans, and making banks more cautious about extending credit. Reduced loan demand. During economic downturn, businesses and individuals tend to borrow less, further influencing banks' lending decisions. Higher interest rates. As interest rates rise, borrowing costs increase for both banks and borrowers, making it more difficult to find qualified borrowers. We'll talk about each of these one by one in a second. Reduced tolerance for risk. Banks may become more risk averse, preferring to lend to low risk borrowers and potentially shifting their lending portfolios away from risky sectors. Kind of talks about that invite only party, right? Self-inflicted tightening. A self-fulfilling cycle can emerge where banks tighten lending standards in response to a downturn, which further exacerbates the credit crunch by limiting the pool of borrowers, according to a report by MIT. So, as you can see, this is a cluster, essentially. This is a conundrum that takes place. You have economic circumstances that lead to banks trying to minimize risk and reduce losses, clamming up and tightening up the pool of people they're comfortable lending to, how much they're comfortable lending in the first place, etc. All of this leads to messed up economic data and reports and activity and lack of activity that turns around and exacerbates the environment for banks to do comfortable lending. So again, as often, it's a symphony, it's a cycle. So when we talk about this from a reverse engineering perspective of how do we position ourselves to not be victim to tighter bank lending standards, right? We're looking at these bullet points one by one. If we talk about increased risk, recessions often lead to a rise in defaults, delinquencies on loans, and making banks more cautious about extending credit. So just focusing on that alone, you want to be the person that they can gauge has a limited chance of defaults and delinquencies, and that financial institution feels like you're in a better shape and less likely to fall in that category or bucket of people. What does that look like? Great credit, not defaulting in the past, and having a long enough credit report and deep enough credit history to show that you've been through other economic downturns or tighter lending cycles in the past. This is a great indicator that you can display to financial institutions to get yourself outside of this risk bucket that they're concerned about. Having great credit, a strong, dense, long-standing credit report, and relationship banking. This is going to be where you have established a deep relationship with the financial institution you're looking to borrow from, because they can look in and see that banking relationship, which gives them more familiarity, more data to pull from to double check your risk level. And this also is going to be one of those situations where they've made money and had good history with you in the past, and that all counts towards when you try to work with them during tougher times. Reduce loan demand. During economic downturns, businesses and individuals tend to borrow less, and further influencing bank lending decisions. Businesses and individuals tend to borrow less. You don't want to be that individual or that business that clams up when things get tough. It doesn't mean go out and borrow money for the hell of it. What it means is that you want to demonstrate a consistent, stable, strategic plan for your financial activity or your investing or your business development or growth. You want to continue to function as business as usual. That includes borrowing, that includes your banking activity, that includes your money coming in and your income coming in. You want to continue to do what you've normally done to the best of your ability based on the economic circumstances. You don't want to be one of those people who was functioning a certain way and then the economy shift and you're clammed up. That's not a good indicator that you're in a healthy situation financially. So that takes care of that one. Higher interest rates. As interest rates rise, which typically they fall during an economic, tightening or downturn. But as interest rates rise, borrowing costs increase for both banks and borrowers, making it more difficult to find qualified borrowers. This is going to be an interesting one. The reason that it's both banks and borrowers is because, believe it or not, banks are retailing money. The Federal Reserve is wholesaling money. The banks are not creating the money out of thin air on their own. They are not the source or the producer of the money. They are the ones that are buying the money, and then they're lending that money out to you. They're renting it out to you. The Federal Reserve is the one printing or punching those numbers in on the keyboard, and that's where banks are generally getting that money from. So that basically means when the Federal Reserve and the core rate that interest rate in our economy goes up, the borrowing cost for the bank goes up, and they pass it along to us, just like every other wholesaler, retailer, consumer chain works. If the wholesaler jacks the price up, the retailer has to pay more, the retailer has to pay more, the consumer has to pay more. It's really the big argument behind tariffs, by the way, to be completely honest and simplistic. So how do you get around this as another factor as we've been reversing and breaking down? Believe it or not, DTI comes to play with this one. Borrowing costs increase for the bank, borrowing costs increase for you as the borrower. That basically means that the debt costs more money. So you have to be able to afford the debt. You have to afford the borrowing cost of the debt. So that basically means if you were going to take out a mortgage at 4% and it was going to run you $2,000 a month, and now the interest rates on that same mortgage that you're going to take out are 5 or 6%, and now it's $2,500 or $3,000 a month, you still have to be able to afford that debt to be a qualified borrower, making it difficult to find qualified borrowers. In order to stay a qualified borrower, you need the cash flow and the DTI to keep up with increased or rising borrowing costs. That also means if you're some sort of investor borrowing money, like a rental real estate investor, buy and hold investor, you may be somebody dealing with private money, hard money, DSCR, debt service coverage ratio loans on that end of the spectrum. You want your investments to still make financial sense on the other end, meaning that they don't care as much about you making money or your personal financial profile. Those lending criteria are typically based on the assets. So that basically means if you want to stay prepared and in proper position for the higher interest rates in this category, that basically means you want your rental properties to have good numbers that keep up with the rising cost of borrowing. Hopefully that makes sense. Reduce tolerance for risk. Banks may become more risk averse, preferring to lend to lower risk borrowers and potentially shifting their lending portfolios away from risky sectors. This is what I preluded to with my analogy. Festival, Mardi Gras, open season, private party, private gala, private mastermind, invite only. I'm going to go with the people I'm most familiar with that have the assets and the stability financially that is easily documented. And I'm going to shift away from the sectors that are business wise or people who work in certain fields or industries that are risky during these economic times. Interest rate sensitive industries, industries tied to discretionary or disposable income, you know, service sector, tourism, things that typically dry up or go stale or slow down when economic downturns come around. So watching what industry you either work or do business in, it's consistency, and then your financial profile as an individual, as a small business. Is it healthy? Do you have assets? Do you have cash flow? Do you have good credit? Do you have a familiar banking relationship? I work for a financial institution right now that is literally forcing their borrowers on the business side to have established banking relationships 1 to 2 years plus before they will lend to them. And they're a decent enough size institution where they could be that damn picky, for one. But for two, it demonstrates familiarity and the ability to look out and see more data. I don't even want to trust your financial statements, your balance sheets, your bank statements from another financial institution. I want to be able to look in right under my profile. I want to look in under the hood of my institution and see what you've been doing. And if you meet the standards the criteria and the standards that we have under this strained economic time. Familiarity, stable financial profile, or a growing financial profile. And, basically making sure that you are positioning yourself to be as healthy as possible in front of these financial institutions by not being in risky sectors with your employment or your business. Or if you are, doing your best to make your case as to why your situation is unique in that industry. Honestly, you may get shut out regardless. I've seen this happen recently with transportation. Financial institution I'm working for, transportation got cut out. I had a client that applied for a line of credit, great cash flow, good tax returns, good credit, banking with us for years. You're out. Don't care. You're in the wrong sector. It happens. The baby will get thrown out with the bathwater. The next one is going to be self-inflicted tightenings. The self-fulfilling cycle can emerge where banks tighten lending standards in response to a downturn. Not much you can do about this. This is a scenario where banks will basically shoot themselves in the foot by stubbing economic activity down the food chain or down the chain of command and making it even more uncomfortable for them to lend. At the end of the day, the name of the game is what I preach in the fundamentals and foundation on this channel. Relationship banking and all of the various components that go into maximizing your borrowing capacity and having a strong net worth. I love cash flow. I know that some people are like, net worth is garbage. Cash flow is everything. I understand what you're saying. The real freedom is in the cash flow. If I own $10 million in assets, but it's not paying me anything, then I get it. I'm not really doing that well. It's not any different than me being, a $50,000 a year W-2 worker. I understand the concept of that. But assets are so favored in the financial system. You always have economic activity and opportunity, rather, when you have assets. And that's why I am very heavy on net worth. Cash flow can be a part of that component, but you can have that 401k that could be using it as an asset without even disturbing it. That life insurance policy. You can have that, stock portfolio, rental portfolio. These things give you options. Even if they're not spitting out cash, there's something valued, tangibly, easily observed, and valued and time tested in the financial system. You can lend against them. You can borrow against them, rather. You can continue to have options. You can invest various creative ways. This is why I value net worth, because when things get tight and tough, banks are going to be looking for so much more to gauge your risk level. And if you have assets, maybe you don't have a ton of cash flow, you might even be in a slightly risky sector, but you might be able to have something you can put up for collateral. You have equipment, you have trucks, you have real estate, you have stock portfolios, life insurance, you have these, other retirement assets, you have something of value, invoices, whatever the case may be that you can exchange, and this bank can mitigate its risk and minimize its potential losses. Comment down below. This is one of my favorite topics. This was another great poll on the channel that covers a huge factor in the health of the economy and a huge factor in your personal economy. So comment down below and let me know what was your perspective, or what is your perspective on tighter lending, tighter bank lending requirements as an individual or as a small business owner, or as a small business owner? I want you to comment down below and let me know what you think, what your mindset is. Are you concerned about it? Do you see the positivity in it? Are you on the right side of the spectrum where it's like, hey, this is going to be positive because I'm going to be one of the few that has everything in place to be one of those prime borrowers? And so they're going to be funneling money into me left and right. Are you somebody who believes that it's going to have a minimal impact for whatever various reasons? I'm not really sure what the psychology behind that one might be. The other end of the spectrum, are you concerned about it? Is it negative to you? Do you not feel like you're in the best position if bank lending gets tighter in the near future? Comment down below. As always, to all my pioneers, welcome back. To my new viewers, welcome in. I really appreciate each and every one of you stopping by, getting value out of each one of these videos, participating in the polls, participating on the channel. You ask great questions that continues to drive this content, so thank you. I also want you to drop down in the description down below. Check in with me on Instagram. I'm expanding out on the social media slowly but surely, growing our committee of pioneers, sharing experiences, sharing knowledge, and continuing to grow out so we can continue to grow together. Other than that, I want you to like, comment, share, subscribe. Support the channel so the channel can continue to support and pour back into you. This is a rare opportunity for you to tie in with somebody who will give you high quality advice. It's a professional and real world in the field. Bring that together and give you a lot of free information, a lot of free engagement, not funneling you through a bunch of sales funnels and marketing funnels, etc. Just giving you raw, uncut quality information. So support this channel so this channel can continue to support and reinvest back into you. I want each and every one of you, as always, to stay focused, stay in motion. I'll see y'all soon.